Just a few years ago, BlockFi was one of crypto's most trusted names, a bridge between traditional finance and the fast-moving world of digital assets. Its promise was simple: earn passive income, borrow against your crypto, and grow your wealth in a new financial frontier. But when the dominoes of 2022 began to fall, first Terra, then Three Arrows Capital, and finally FTX, BlockFi went down with them. But first, let's rewind to the beginning. BlockFi was founded in 2017 by Zach Prince and Flory Marquez, who wanted to bring familiar financial products into the crypto space. Prince came from tech and sales, while Marquez managed financial portfolios. Together, they saw an opportunity that banks weren't touching. In January 2018, BlockFi launched its first product, crypto-backed loans, that let users borrow cash by depositing Bitcoin or Ether as collateral. A year later came the product that put BlockFi on the map, interest-bearing accounts offering up to 6.2% APY on crypto deposits. Within months, users had deposited over $50 million. As the crypto bull market surged, so did BlockFi, which quickly became one of the top lending platforms. By 2021, it completed its last and most successful funding round that valued the company at $3 billion. At its peak, BlockFi offered zero-fee trading, institutional lending, and even launched its own Bitcoin trust. It reportedly handled $15 billion in assets from over 225,000 users. BlockFi was also generating revenue by deploying its own capital into arbitrage trades, like the Grayscale Bitcoin Trust. By 2022, though, the tide had started to turn, and BlockFi soon found itself caught in the storm. The collapse of Terra sent shockwaves across the crypto industry, triggering a lender crisis that exposed just how connected many firms had become. By June, BlockFi had around $1.8 billion in open loans and $600 million in exposure. A significant portion came from loans to Three Arrows Capital, the hedge fund that collapsed after the Terra crash. BlockFi managed to liquidate its collateral before the fund went bankrupt, but the fallout still left a dent. Desperate for a lifeline, BlockFi turned to what looked like safe harbor, FTX. The exchange extended a $400 million line of credit, with an option to acquire BlockFi for up to $240 million, a steep drop from its previous valuation. It seemed like salvation, but just a few months later, the truth about FTX fraud began to unravel. Reports revealed how customer funds were being misused between FTX and its sister company, Alameda Research. Under the microscope, the exchange crumbled and filed for bankruptcy just 9 days later. That was the final blow for BlockFi. Withdrawals were paused, and on November 28, 2022, the company filed for bankruptcy. BlockFi reported between $1 billion and $10 billion in assets and liabilities. It also came to light that BlockFi had up to $1.2 billion in assets trapped on FTX and Alameda Research. In October 2023, BlockFi announced it had a plan to repay creditors and customers using funds recovered from counterparties like FTX and other debtors. A year later, BlockFi finally got the green light from the court to repay its customers and creditors in full. Progress has been gradual, but it's underway, a small measure of relief to affected customers after a long and chaotic journey. BlockFi's collapse stands as a reminder that in crypto, contagion can spread fast, even to companies that didn't commit fraud themselves. And if you want to see how that chain reaction ended, watch our video on how the FTX empire came crashing down.